Welcome to the deep dive. It is Wednesday, March 11th, 2026. And look, if you've been feeling a bit of whiplash lately from just the relentless pace of the news cycle, you are absolutely not alone.
Yeah, the world is moving incredibly fast right now.
It really is. And the sheer volume of information you have to process can be overwhelming. So today's deep dive is designed specifically for you to help cut through that noise.
Exactly.
We're going to take a massive stack of current events spanning a major geopolitical conflict in the Middle East, wild shifts in economic indicators, a housing market that's just stuck in this bizarre limbo, and of course, the hyper-accelerating artificial intelligence boom.
Right, and we're going to extract the actual signal from the noise.
Because looking at this stack of material, the overarching theme that binds all these seemingly disparate events together is interconnectedness.
It's all connected. We are going to explore the mechanics of how, say, a projectile hitting a cargo ship halfway across the world eventually changes the price of the fertilizer you use to grow your food.
Which is crazy to think about.
It is. We'll look at how that exact same event impacts the plastic in the car you drive. And we'll unpack how artificial intelligence is fundamentally changing the way massive banks value traditional everyday software companies.
Right. Nothing we are discussing today happens in a vacuum.
Not at all.
So that is the mission today. We want to give you a thorough, balanced understanding of how these macro forces directly impact your daily life, your wallet, and your future. So let's just jump right into the deepest end of the pool.
Let's do it.
Let's unpack the situation in the Middle East. The escalating war involving Iran really kicked into a new gear back on February 28th with a series of airstrikes from the U.S. and Israel.
Yeah.
But what the data shows is that this is no longer just a localized kinetic conflict. It is bleeding directly into global shipping lanes.
Which fundamentally changes the risk calculus for the entire global economy.
Right. Specifically, the UK Maritime Trade Operations, the UKMTO, they reported that 3 commercial cargo ships were struck by suspected projectiles right off the coast of Iran.
And one of those vessels was the Thailand-flagged Nari.
Right.
When a commercial vessel like that is struck, I mean, it's not just a geopolitical incident anymore. It's an immediate logistical nightmare.
And the military response to that has been intense. U.S. Central Command reported sinking 16 Iranian mine layers.
Yeah, and that's a huge deal.
Well, let's pause there for a second because I want to make sure we understand the specific threat here. A mine layer isn't, a massive destroyer.
No, not at all.
So why is the sinking of 16 of them such a critical data point for the global economy?
It's a crucial detail because of the geography involved. We're talking about the Strait of Hormuz.
Right.
I mean, for anyone out there picturing a vast open ocean, the Strait of Hormuz is the exact opposite. It is a remarkably narrow maritime corridor.
It connects the Persian Gulf to the Gulf of Oman, right?
Exactly, and eventually to the Arabian Sea.
Yeah.
At its narrowest point, the shipping lanes in either direction are only about 2 miles wide.
2 miles. That is nothing.
It's basically a bottleneck.
Yeah.
So when you introduce mine layers into a choke point that narrow, you are introducing the capability to completely blindside commercial shipping.
Because a sea mine doesn't discriminate.
Right. It doesn't care if it's a naval warship or a commercial vessel carrying consumer goods. And in normal times, roughly 20% of the world's global oil and gas supply passes through the single choke point.
That is just a staggering bottleneck.
It really is. You're looking at something like 15 million barrels of oil a day, plus another 5 million in other refined oil products.
Wow.
So when you have active military engagements, projectiles hitting cargo ships, and the very real threat of sea mines in a 2-mile-wide lane commercial shipping essentially grinds to a halt.
Yeah, the physical risk to the crews is just too high.
Absolutely. And as we'll see, the financial risk becomes completely untenable.
And the market reaction certainly reflected that panic. I mean, we saw Brent crude, which is the global oil benchmark, touch a massive $119.50 a barrel earlier in the week.
Huge spike.
Now, it has since settled down a bit, hovering around $90 a barrel, but that is still a significant premium. U.S. West Texas Intermediate futures also climbed over 4% to roughly $87.
Yeah.
But here's where it gets really interesting to me. Getting those ships moving again isn't just a matter of sending in military escorts to clear the way.
Not at all.
The underlying mechanics of global trade dictate that it is fundamentally a matter of insurance.
Insurance is the invisible engine of global trade. I mean, commercial ships simply do not move without it.
Right.
Underwriters calculate risk down to the fraction of a penny, and right now, They are understandably terrified.
Because if a ship gets hit, it's not just the loss of the hull.
Exactly. So we're seeing the U.S. government actually step in to backstop the market because private insurers just won't touch it.
The U.S. International Development Finance Corporation, the DFC, right?
Yeah, the DFC has stepped up to lead a $20 billion reinsurance program.
Okay, I want to dig into that because reinsurance is one of those words that gets thrown around in financial media all the time. But the actual mechanics are fascinating. How does a $20 billion program like this actually get a ship to sail through a literal war zone?
Think of reinsurance as insurance for the insurance companies.
Okay.
If a primary insurer writes a policy for a massive oil tanker, a total loss could wipe out that insurance company entirely.
Right, the payout would be astronomical.
Reinsurance spreads that risk around. In this case, the DFC has named Chubb, which is an absolute giant in the insurance world, as the lead underwriter for this initiative.
So they are managing this massive pool of capital.
Yes, this $20 billion pool is designed to provide comprehensive coverage. It covers the hulls of the ships, which are worth tens of millions. It covers the massive complex machinery inside.
It covers the cargo itself.
But crucially, and this is where the liability gets truly insane, it covers environmental damage from potential oil spills.
Right, because if a tanker gets hit by a projectile and spills millions of gallons of crude into the Gulf, the cleanup costs and the legal liabilities would be catastrophic.
Exactly. The government is essentially trying to financially engineer a way to keep the global economy's most vital artery from clotting completely.
Because if underwriters know there is a $20 billion backstop guaranteed by the U.S. government, they will start writing policies again.
And that means the ships will start moving again.
And while this financial maneuvering is happening behind the scenes, the political response domestically has been very front and center.
It has.
And just as a quick note here, we always want to make it explicitly clear to you, the listener, that when we discuss these political statements, we are merely reporting the perspectives found in our sources.
Right. We are absolutely not endorsing any political viewpoints.
Exactly. We just want to give you the raw data of what is being said so you have the full picture.
The impartial facts.
Right. So looking at the statements coming out this week, President Trump stated that Iran has effectively lost its Navy and Air Force in the wake of these strikes.
He also expressed his belief that despite the deployment of those mine layers we mentioned, Iran has not successfully mined the Strait of Hormuz.
Furthermore, he explicitly stated he is not worried about the potential for domestic terror attacks in retaliation for the U.S. involvement.
And the diplomatic ripples from all of this are spreading into Europe, too.
Yeah, the Spain situation.
Exactly. The president floated the idea of potentially cutting off trade with Spain.
And that stems from the fact that the Spanish government barred the U.S. military from using bases in Andalusia for these Middle East operations, right?
Yes. When you look at a map, the southern coast of Spain is a critical logistical launching pad for operations pushing into the Mediterranean and toward the Middle East.
So being denied access to those bases complicates the logistics of the current operation pretty significantly.
It absolutely does.
Meanwhile, the international community is trying to treat the immediate economic symptoms of the crisis. We saw the International Energy Agency, the IEA, agree to a historic emergency action.
Right. They're releasing 400 million barrels of oil from emergency stockpiles.
That is just a massive injection of supply.
The goal there is to essentially flood the global market to counteract the bottleneck happening in the Strait.
Yeah.
It's a blunt instrument to bring those $119 a barrel spikes back down to reality.
And the U.S. has a major decision to make on this front, right? The U.S. Strategic Petroleum Reserve currently holds about 415 million barrels.
And President Trump is currently weighing whether the U.S. will participate in that coordinated IEA release using those reserves.
So if I'm listening to this right now, I'm probably thinking, okay, oil is spiking, ships are stalled, governments are organizing historic releases of emergency reserves.
Yeah.
How does this actually hit my wallet beyond just the price of a gallon of gas? Because we know gas prices are already dripping, but the ripple effects of a 20% disruption in global oil have to be wider than just the pump.
They're significantly wider, and they bleed directly into the core of the economy. Let's look at the inflation picture.
Okay.
The official Consumer Price Index, the CPI, for February rose 2.4% annually.
Which was unchanged from January and basically exactly in line with what economists were expecting.
But there is a massive blinking red warning light on that data.
It's essentially stale.
Precisely.
Yeah.
Because it was collected before the war began, The February CPI data is a snapshot of an economy that no longer exists.
It does not reflect the current oil shock that kicked off on February 28th.
Exactly. So while the official government numbers look steady and controlled, the reality on the ground, the reality that manufacturers and shipping companies are dealing with right now is shifting rapidly.
Which means we need to look at what was driving that 2.4% inflation before the Middle East conflict even started.
Right.
And again, keeping this strictly to the facts of the sources, the data shows that the baseline inflation was largely underpinned by tariffs.
Yeah, the Supreme Court recently struck down President Trump's original 14.3% average effective tariff rate.
But the administration quickly introduced new tariffs to keep the effective rate at 10.5%.
And just to put that number in historical context, a 10.5% effective tariff rate is the highest the United States has seen since 1943.
Since 1943. And this is where the interconnectedness really starts to squeeze the average person.
What happens when you take an economy that is already digesting the highest tariff rate since World War II, and you suddenly inject a massive, unpredictable supply chain shock right on top of it?
You get intense compounding pressure on everyday consumer goods.
Let's trace that pressure directly to the grocery store.
Yeah, because I think most people don't immediately connect a maritime conflict in the Strait of Hormuz to the price of a box of cereal.
But the link is actually incredibly direct. It all comes down to fertilizer.
Fertilizer.
Over 1/3 of globally traded fertilizer passes through that exact strait. Modern agriculture is entirely dependent on these global supply chains.
And the numbers we have are wild. In just the first week of this conflict, U.S. prices for imported urea, which is a critical nitrogen-based fertilizer, jumped 30%.
30% in a single week.
And the timing of this is critical, right?
Yeah.
Because we are right on the edge of the spring planting season.
Exactly. This isn't happening during the dormant winter months. Farmers are making their purchasing and planting decisions right now.
So if urea and other fertilizers become 30% more expensive, or if the shipments are simply delayed and unavailable,
Farmers are forced to make hard choices. They will likely reduce their application rates to save money. But if you use less fertilizer, you get lower crop yields.
we are talking about staples here: corn, soybeans, wheat.
Analysts are already warning that this specific disruption in the strait could raise food-at-home inflation by a full 2 percentage points.
Wow.
So the cost of feeding livestock goes up, the cost of baking bread goes up, and the consumer pays for all of it.
But it's not just agriculture getting hit. The auto industry is facing a dual threat from this exact same choke point.
Yes.
First, when oil prices spike, the cost of petrochemicals skyrockets. And in a modern car, plastics make up roughly 30% of the parts.
Everything from the dashboard to the bumper to the interior trim suddenly costs more to manufacture.
But the second threat is even more structural.
The aluminum factor.
Explain that.
The entire auto industry, but especially the electric vehicle sector, is obsessed with lightweighting. EV batteries are incredibly heavy, so manufacturers use massive amounts of aluminum to offset that weight and improve range.
Right.
But smelting raw aluminum is one of the most energy-intensive industrial processes on the planet. And Bahrain and the United Arab Emirates, located right there in the Gulf, account for 9% of global aluminum smelting.
So you have plastics derived from oil and aluminum smelted in the Gulf, both suddenly at risk.
Right. And this dynamic creates what is often referred to as a crocodile jaws effect on the economy.
I love that visual.
Imagine the top jaw is the upward pressure on prices coming from those historic 10.5% tariffs on imported goods.
Okay.
The bottom jaw is the sudden, violent rising cost of raw materials and energy due to these supply chain choke points in the Middle East.
And as a consumer or as a domestic manufacturer, you are caught right in the middle as those jaws snap shut.
Exactly. Your imported components cost more, and your raw commodities cost more simultaneously.
That is a brutally clear visual, the crocodile jaws of inflation.
Yeah.
And while those jaws are clamping down on the broader economy, the machinery in Washington is dealing with its own internal structural shifts. Let's look at the federal deficit.
This is fascinating.
Through February of this fiscal year, the U.S. budget deficit officially surpassed $1 trillion.
It's a massive number, but there is a really fascinating detail hidden in the ledger. That $1 trillion deficit is actually 12% lower than the deficit was at the exact same point in 2025.
Wait, how is the deficit shrinking by 12% when spending seems to be constantly increasing?
It goes right back to the top half of those crocodile jaws, the tariffs.
Ah.
Customs duties, which is the revenue the government collects from tariffs, surged an incredible 294% to $151 billion in just the first 5 months of the fiscal year.
To really grasp the magnitude of that shift, the U.S. government is currently collecting more money from import tariffs than it is from corporate tax receipts.
Which is just a fundamental rewiring of how the federal government is funding its operations.
But even with that massive influx of tariff revenue, the expenses are astronomical, particularly when you look at the cost of simply carrying the debt.
Net interest payments on the $39 trillion national debt hit $79 billion in February alone.
Just paying the interest is consuming a staggering portion of the budget.
It is.
And managing this incredibly complex economic machine requires steady leadership, which brings us to some major personnel shifts happening in Washington. President Trump has nominated Markwayne Mullin to replace Kristi Noem as the Secretary of Homeland Security.
Mullin brings a very unique background to the role. He's a former MMA fighter, a rancher, and he has a very hardline stance on immigration.
And the political reactions have been predictably divided. And again, just impartially sharing the perspectives from the sources here, lawmakers on the left have signaled they expect no meaningful policy changes from this swap.
Right, they view it simply as a continuation of the administration's current approach.
On the right, lawmakers view Mullin as an independent, disciplined leader who will bring a renewed focus to the department, particularly when it comes to prioritizing the deportation of dangerous criminals.
But the real drama, the standoff that directly impacts those $79 billion interest payments we just talked about, is happening over at the Federal Reserve.
Right. President Trump has nominated Kevin Warsh to replace Jerome Powell as the Fed chair. However, that nomination is currently blocked in the Senate by Senator Thom Tillis.
And the reasoning here is highly unusual.
Very.
The current Fed chair, Jerome Powell, is under a federal criminal investigation regarding testimony he previously gave to the Senate.
So Senator Tillis is blocking the Warsh nomination essentially on the principle of institutional integrity, arguing that the process shouldn't move forward while the current chair is under federal probe.
Meanwhile, you have Senator Tim Scott, who chairs the Banking Committee, publicly stating he hopes the probe into Powell simply goes away so the Senate can confirm Warsh and get a fully functioning Fed back on track.
Which perfectly illustrates that interconnectedness we talked about at the top of the show.
Exactly.
You have a stalled nominee for the Federal Reserve. The Fed is the entity that controls monetary policy and interest rates.
Those interest rates directly determine how much of a burden that $39 trillion national debt is, which then impacts the overall deficit.
And all of this high-level gridlock is happening while the broader economy is trying to digest supply shocks in the Middle East and historic tariffs.
It is a giant, incredibly complex ecosystem. A bottleneck in the Senate Banking Committee can be just as impactful to the national ledger as a bottleneck in the Strait of Hormuz.
Exactly. So we've looked at the global shipping lanes, the macroeconomy, and the maneuvering in Washington. Let's bring this all the way down to the ground level.
The consumer level.
Right. How are average people navigating this environment? Let's look at the housing market and personal finance, starting with a snapshot of housing. Existing home sales actually bounced back a bit in February, rising 1.7%.
And the median sales price is currently sitting at $398,000.
But the top-line numbers don't tell the whole story. When you look at the demographics of who is actually buying these homes, it's a very fractured market.
First-time buyers make up 34% of the market. But the truly striking statistic is that all cash buyers represent a massive 31% of all transactions.
I want to make sure I understand the weight of that. Nearly a third of all homes being sold right now are being bought outright, with no mortgage.
Yes. It tells us that almost a third of the market is completely insulated from the Federal Reserve, from interest rates, from everything we just discussed.
They have the accumulated capital to bypass the borrowing market entirely.
Exactly. But for the remaining two-thirds of the market that does rely on borrowing, mortgage rates did decline slightly to 6.14%.
And the second those rates dipped, we saw an 11.3% jump in refinancing applications.
People are desperate to lower their monthly overhead, but actual purchase applications dropped. The demand is there, but the inventory is just incredibly tight.
And the data suggests that tight inventory isn't going to be solved anytime soon because the pipeline for new construction is slowing down.
Loans for acquisition, development, and construction, what the industry calls AD&C loans, fell 1.5% to $456.3 billion.
And single-family housing permits ended 2025 down 7.4% year over year. Builders are pulling back their investments.
Which is what makes the current legislative standoff in Washington so consequential. There's a major bipartisan housing affordability bill that successfully passed through the House and has strong support in the Senate.
But it has hit a complete standstill.
Right. President Trump is pushing for a provision that would ban major investors and corporations from buying single-family homes, aiming to stop Wall Street from competing with regular families.
Which sounds great on paper for a first-time homebuyer, but what are the actual mechanics of a ban like that?
This is a textbook example of unintended consequences. The Senate version of the bill tries to compromise. It bans companies from owning more than 350 homes. But crucially, it includes a 7-year exception for home builders. Under this exception, a company can build and own homes, but they are legally mandated to sell them to non-corporate buyers within 7 years.
Wait, so if I'm a major developer, I can build a massive neighborhood, but the government dictates that I have a strict 7-year ticking clock to offload every single property.
Exactly. And that is why House members are raising alarms. The concern is that if you force companies to liquidate their assets within a strict time frame, you completely change their risk model.
Because they might not be able to hold on to them if the market dips.
Right. You will inevitably choke off the massive amount of institutional capital that is required to actually fund large-scale new home construction.
So you might successfully stop corporations from hoarding existing homes, but you accidentally stop them from funding the construction of new homes.
Which is the only real mathematical way to solve the inventory crisis. It's a delicate balancing act, and it has completely frozen the legislation.
And while Washington is frozen over how to build more houses, consumers are falling into what looks like a deeply concerning debt trap.
Credit card balances have officially hit a record $1.28 trillion.
And to cope with that mountain of revolving debt, consumers are increasingly turning to personal loans.
The logic driving this behavior seems very sound on the surface. The average personal loan interest rate is around 12.26%.
While the average credit card interest rate is sitting at an agonizing 19.58%.
So a consumer takes out a personal loan at 12%, uses it to pay off the credit cards at 19%, and consolidates their debt at a lower rate. Mathematically, it is the correct move.
But behaviorally, it's a trap.
It is a massive trap. If you consolidate the debt, but you do not fundamentally fix the underlying spending habits that caused the debt in the first place, you end up in a much worse position.
Because now you have a monthly payment on a personal loan, and within a few months, you start running up the balances on those zeroed-out credit cards again.
You haven't eliminated debt. You've just duplicated your credit lines. And the data backing this up is frightening. 14 to 17% of all new personal loans are now being used simply to refinance older personal loans.
How does that even happen? How do lenders approve rolling over an old personal loan into a new one without questioning the underlying behavior?
Lenders look at current cash flow and credit scores, which might artificially look okay right after a consolidation, but it becomes a never-ending cycle of moving deck chairs on the Titanic.
The consumer gets short-term relief, but the aggregate debt burden just keeps growing.
You cannot simply borrow your way out of debt.
So how do you actually break that cycle? How do you flip the script on a consumer economy that is designed to drain your checking account?
The concept that stood out to me from the analysis is this idea of forced savings.
Right.
It's essentially taking the power of automated expenses, which usually work against you, and turning them into tools that quietly build wealth or protect you from sudden financial ruin.
The psychology of forced savings is vital. When money is automatically withdrawn from your account to pay the minimum balance on a credit card, it generates anxiety. You are paying for past consumption.
But when money is automatically deployed into a forced savings vehicle, it builds long-term confidence. Homeownership is the classic, perhaps the most powerful example.
Because making a mortgage payment every month feels like a massive expense.
But historically, and especially recently, with values appreciating 8 to 9% annually since 2020, a portion of that payment is going toward principal. You are literally forcing yourself to buy an appreciating asset every single month.
And beyond the mortgage itself, there are automated ways to protect yourself from the sudden, catastrophic expenses that usually force people onto those 19% credit cards.
A great example is a home warranty.
Yeah, companies like Choice Home Warranty or American Home Shield. They might cost you $500 to $700 a year in automated payments.
But when your furnace completely dies in the middle of a blizzard, which can easily be a $12,000 replacement job, that warranty absorbs the shock.
You forced yourself to proactively save for the disaster, rather than financing the disaster after the fact.
Exactly. You are paying a small premium to avoid a catastrophic debt event, and this applies to long-term wealth building too.
Automated contributions to a 401k or an IRA compound significantly over decades. The money leaves your paycheck before it ever hits your checking account, so you never feel the loss of spending it.
Permanent life insurance policies from providers like Mass Mutual or Pacific Life function similarly. They build cash value over time that you could eventually tap into.
Even pet wellness plans fit this model. Vet bills are up 7.4% this year alone.
If you have an automated plan from Pumpkin or Spot, you are forcing yourself to budget a small amount monthly so you aren't hit with a massive multi-thousand-dollar bill when your dog suddenly needs emergency surgery.
And if you simply want cash on hand but want to beat inflation, automating transfers into a high-yield money market account at places like Quantic or ZYNLO, which are yielding around 4% right now, is a great way to force liquidity.
It's all about automation working for you, not against you.
Right. So I would ask you, the listener, to take a hard look at your automated expenses this month. Are they silently draining your wealth to service past debts, or are they quietly building a fortress around your financial future?
It is a subtle shift in how you arrange your cash flow, but it changes everything over a 10-year horizon.
It really does. And speaking of subtle shifts that change everything, we need to pivot to the final major theme of our dive today, which might be the most consequential of all.
We are looking at Wall Street, big tech,
Yeah.
and the absolute explosion of the artificial intelligence boom.
And the most fascinating entry point into this topic is a massive hidden shift happening right now at JP Chase.
Yeah, this one is huge.
I was reading through this part of the material earlier, and I had to read it twice to make sure I understood the implication. JP Chase, the biggest bank in the United States, is quietly reining in its lending to private credit firms.
Right.
And specifically, they are preemptively marking down the value of software loans that these private credit firms use as collateral.
Yes.
So for the listener who might not trade commercial debt, what exactly is private credit, and why in the world would Jamie Dimon's bank suddenly decide that loans to traditional software companies are worth less?
This is a brilliant example of how fast AI is rewriting the rules of finance. Private credit is essentially non-bank lending. It's investment firms like Blackstone or Blue Owl lending money directly to companies, often using the recurring revenue from software subscriptions as collateral.
Okay.
But JP Morgan isn't marking down the value of these software loans because the companies are currently failing or missing their payments. They are doing it based purely on future valuation fears.
Fears of artificial intelligence.
Exactly. The advances from AI models, like those built by OpenAI, Anthropic, and others, are becoming so profound that Wall Street is terrified that traditional legacy software companies are going to be completely disintermediated.
Disintermediation just means cutting out the middleman.
Think about it. If an AI agent can write custom code, generate dynamic workflows, and solve specific business problems on the fly, why does a corporation need to pay for dozens of rigid, specialized, expensive software subscriptions?
JP Morgan is essentially looking at the landscape and saying, we no longer trust the long-term 10-year value of these legacy software companies as collateral because AI might render their entire business model obsolete.
That is exactly what they're doing.
That is a staggering vote of no confidence in the traditional software industry. It's triggering a down cycle for these private credit firms who are suddenly facing high redemptions from their investors and tighter borrowing limits from the big banks.
It is a preemptive strike by the financial sector against impending technological disruption.
But if the software layer is suddenly viewed as vulnerable, the infrastructure layer, the physical hardware running these massive AI models, is becoming more valuable than gold.
And we see that perfectly illustrated by Meta's latest move. Meta just rolled out not one, but 4 custom in-house AI chips. The MTIA 300, 400, 450, and 500.
They are having them manufactured by TSMC in Taiwan, and their timeline seems almost impossibly aggressive. They are planning to release a new chip architecture every 6 months.
Which is an incredibly difficult cadence to maintain in semiconductor manufacturing. But they are doing it because leverage and independence are everything in the AI arms race right now.
Meta is spending tens of billions of dollars on capital expenditures to build massive, sprawling data centers.
If they rely solely on buying GPUs from NVIDIA or AMD, they are entirely at the mercy of those vendors' pricing power and their supply chain bottlenecks.
So they are building their own hardware to escape the monopoly.
Yes. By designing their own chips, they can optimize the silicon exactly for their own specific workloads. They don't need a chip that does everything. They need a chip that perfectly executes the ranking algorithms on Instagram or perfectly generates images for WhatsApp.
By controlling the design, they insulate themselves from price gouging and guarantee their own supply. They are taking absolute control of their own destiny at the silicon level.
And speaking of controlling destiny at the infrastructure level, let's look at Oracle.
Their stock just spiked 9% on the back of an incredibly strong earnings report. They reported $8.9 billion in cloud revenue, which is a massive 44% jump.
Building out AI infrastructure requires a jaw-dropping amount of capital, and investors have been incredibly nervous about tech companies taking on massive debt to build data centers.
But Oracle CEO Clayton McGork managed to completely reassure Wall Street. He pitched this bring your own hardware model, which essentially gets their customers to pay up front for the infrastructure.
Because of that cash flow, he was able to boldly state that Oracle will not need to issue any more debt in 2026.
That was the magic phrase the market was waiting to hear. Oracle proved they could fund the AI expansion through actual cash flow and customer commitments rather than leveraging their balance sheet.
And buried in Oracle's financial filings was another fascinating nugget regarding their involvement with TikTok.
Right, the TikTok USDS joint venture. Oracle holds a 15% stake in this newly formed U.S. entity, alongside Silver Lake and MGX, with ByteDance holding under 20%.
Oracle's stake is valued at roughly $2 billion.
Why does a legacy database and cloud infrastructure company own a multi-billion-dollar piece of a viral social media app?
It comes down to data sovereignty and national security. After the intense regulatory pressure and the forced divestment of TikTok's U.S. operations from its Chinese parent company, ByteDance, this new entity was formed.
But the government required a trusted American technology partner to secure and host the data of U.S. citizens.
Oracle stepped into that role. Their 15% equity stake, valued at $2 billion, puts the total valuation of TikTok's U.S. operations around the $13 to $14 billion mark.
It shows how deeply embedded a legacy tech infrastructure company can become in the modern consumer social media landscape when data security becomes a national priority.
And the developments across the tech and corporate landscape right now are just relentless. Microsoft is already planning to ship prototype next-generation Xbox consoles to developers in 2027.
They are sticking with custom AMD chips, promising massive leaps in ray tracing performance to render incredibly realistic lighting and shadows.
Meanwhile, the battle over the data that actually trains these AI models is getting fierce. Amazon just won a major court order to block Perplexity's AI shopping assistant, which is called Comet, from scraping Amazon's website.
Amazon is aggressively protecting its marketplace data, so you have to use their own internal AI agent, Rufus.
And it's not just tech companies. Legacy industrial companies are desperately trying to pivot to software and AI to improve their margins. Ford just launched a product called Pro AI for its 840,000 commercial fleet subscribers.
They are analyzing 1 billion data points a day.
A billion data points a day from commercial vans and trucks.
What are they even analyzing?
Everything from route optimization and fuel efficiency to granular details like seatbelt use and braking patterns.
They package that intelligence and sell it back to the fleet managers to help them increase efficiency and lower insurance costs.
For Ford, it's a way to generate high-margin, recurring software revenue rather than just relying on the one-time sale of the physical vehicle.
We are also seeing major moves in the fintech space. Revolut, the massive financial technology startup, finally acquired a full UK banking license.
That is a game changer because it unlocks their ability to offer actual lending products, transforming them from essentially a digital wallet into a true, formidable banking institution.
And on the more traditional corporate side, we are seeing the effects of shifting consumer habits. Papa John's Pizza just received a $1.5 billion takeover bid, that's $47 a share from Earth Capital, to take the company private after they were forced to close over 100 stores.
And Campbell's Soup hit a 23-year low due to heavily slumping snack and soup sales.
When you synthesize all of these data points from the corporate world, a very clear, profound picture emerges of an economy in transition.
Legacy software is being preemptively devalued by the threat of AI, as we saw with JP Morgan's lending practices.
The physical infrastructure layer, the custom chips, the data centers, the energy required to run them, is experiencing a massive boom as evidenced by Meta and Oracle.
Legacy industrial companies like Ford are desperately embedding AI into their physical products to squeeze out software-like margins.
And the tech titans like Amazon and Perplexity are fighting vicious legal battles over the proprietary data needed to train these models.
The entire corporate landscape is reorganizing itself around the gravitational pull of artificial intelligence.
It truly is a paradigm shift playing out in real time. And that brings us to the end of our journey today. We have covered an immense amount of ground.
We really have.
We started by tracking literal projectiles flying in the narrow Strait of Hormuz, threatening the global supply of oil, the aluminum needed for electric vehicles, and the fertilizer required to grow our food.
We traced how those physical supply shocks, combined with historic 10.5% tariffs, are creating inflation crocodile jaws that squeeze the consumer at the grocery store.
We watched Washington struggle with trillion-dollar deficits, massive interest payments, and housing bills that are stalled over how to regulate corporate buyers without killing new construction.
We looked at the mathematical trap of rolling over personal loans and how to build a financial fortress through forced savings.
And finally, we explored the multi-billion-dollar infrastructure wars of the AI revolution, where banks are betting against software and tech giants are building their own silicon. I know tracing these lines can feel like drinking from a fire hose.
That's a lot of information.
But understanding how all these disparate pieces connect, how a ship in the Middle East relates to the cost of your cereal, and how AI relates to your bank's lending policies, that is the ultimate shortcut to being truly well-informed.
You can see the underlying mechanics of the world a little more clearly now.
And I want to leave you with one final thought to mull over as you go about your week.
Today, we discuss JP Morgan aggressively devaluing digital software companies because artificial intelligence is getting so capable and so ubiquitous.
But simultaneously, we discussed how a physical geographical choke point in the Middle East is threatening the basic, tangible materials needed to build cars and grow crops.
As we move deeper into the 2020s, ask yourself this. Are we rapidly approaching a future where digital intelligence becomes incredibly cheap and overwhelmingly abundant, while physical, tangible commodities, clean water, reliable energy, raw metals, and secure food become the ultimate scarce luxury?
That is exactly the kind of question that forces you to rethink how you view the future. Thank you so much for joining us on this deep dive. Stay curious, keep connecting the dots, and never stop questioning the world around you. We'll see you next time.